Welcome everyone to the first FMD Investment Committee update for 2022. My name is Lee Wappling, I'm the CEO at FMD Financial, and I'd like to welcome our participants this month, and Richard Dahl, the Chair of the Investment Committee, FMD Investment Committee. Welcome, Richard. And Mike Reynolds, the Director of FMD and Investment Committee member. Thank you again both for joining us today. Well, when we started to prepare for this session, we thought it would be a look back on the 12 months to 31 December, and we would say, well, it's been a very strong period of time, that 12 months to 31 December. But here we sit, nearly 8 weeks into 2022, and it's been a bit bumpy since the end of January, Richard.
Yeah, so leading into the end of December, markets, both equities and bonds all have performed reasonably well. There's been more volatility in the bond market last year. And some of that was around potential uplift in interest rates coming with inflation on the horizon. But and part of that was when we get into talking about changes in the portfolio is what might happen to interest rates and their impact on bonds. Well, what we did see in January, Lee, was a large impact on both the bond market and the equity market.
I might come back to that in a moment, Richard, but Mike, can you talk us through the changes, and perhaps with Richard's support, the changes to the portfolios, the AMS portfolios over the last few months since we last spoke?
So we'd run a part of our fixed interest portfolios in AMS last year to have some defensive capabilities if equity markets became difficult through effectively our government bond exposure. And the interest rate cycle we saw had run its course, coming to an end, and we were pretty much at the bottom of the cycle where central banks had got themselves into a situation where they needed to start to raise interest rates. So as part of that process, we exited our longer dated government bonds and moved our fixed interest position to what we would typically call short duration. And that basically protects the capital values of a bond in a rising interest rate environment. You know, we suffered some losses on our bond positions in the fact that we probably should have moved a little bit earlier, but that's the timing of those things is always getting that 100% right is challenging. But that's what we did. We made that move. Sorry,
Mike, before you go on, which funds were they and what were the movements there?
So JCB Bond Fund, which is an Australian government bond fund, was redeemed, and those funds were then rotated into Metrics Direct Credit Fund, which is a specialist non-bank lending fund manager in the market, manages about $10 billion here in Australia and has had a terrific few years in running that specialised credit origination part of the portfolio. We also removed Solaris as a domestic long-short manager and made some adjustments by introducing some smaller company fund exposure through Firetrail, and take into account what had happened in the last sort of 18 months with COVID and the uncertainty around occupation of office buildings, like where we are here, back in the office today. There'd been some disruption in the assessed value of commercial property, and we introduced resolution on a global property side of things as part of the restructure of our positions.
Thanks, Mike. So, Richard, we also had a relatively recent and fairly dramatic change or quick change to our portfolios as well in Magellan. Could I get you to talk to the rationale behind that?
Yes. So, Lee, while it was a quick change, it was the culmination of a few events that took us to that decision. Through last year, we communicated that we'd had some performance concerns about how Magellan had performed the returns coming out of COVID, and they made a large macro call with regard to looking at that as a health crisis, and were reasonably defensive and then markets rebounded strongly. That was one of our review considerations last year. But then later into 2021, what surfaced in the press was some corporate instability in the organisation. Initially, the CEO, Brett Cairns, we communicated this to clients that he departed the organisation, having been in that organisation for a period of time. And then there was also press about Hamish Douglass, the key person in the organisation, his own personal life, and some challenges there. And this also what flowed on from that was a very large group in the UK that redeemed a significant proportion of their money that Magellan were investing. So we requested a meeting with Magellan and with Hamish Douglass, and we were able to arrange that, and it was a recorded interview with Hamish where we went through and looked at a number of those issues and in the company. But what has transpired since then is that Hamish Douglass has taken personal leave for a period of time. So key person in the organisation. It's one of the reasons that when we do appoint fund managers, is their point of difference to other groups and their value adding. And a key person who's been on the long journey was removed. They restructured. They brought in the other co-founder, Chris Mackay, in the organisation, made a number of other changes. We convened the FMD Investment Committee rather quickly to have a look at that. And one of the things we look at, Lee, in deciding when we appoint a fund manager, there are a number of criteria, and stability within the organisation is one of the key criteria, because a stable organisation is one that has more chance in adding value to our clients' portfolios. And while they've taken a lot of steps with Magellan to replace Hamish, although that we're told he might be returning, it was the investment committee's view that the stability was not necessarily going to be there when they went through this change. So we've made the decision to keep the money in the market, so to speak, exposed in the market, and redeemed that money that was with Magellan to put it into the Vanguard International Shares Fund mainly. There was also some infrastructure funds we've replaced. And the plan is to give ourselves time, the investment committee, to do our due diligence in looking at a replacement. But the important message to clients is that we will be watching from the side as Magellan go through the changes with Hamish gone, and if Hamish returns, and we haven't closed that door to come back and have a look at Magellan in the future.
Thanks, Richard. And I think that's absolutely demonstration. We name our investment management service the active management service, and that's a classic example of where in a situation that was whilst we'd been concerned about the fund, it was unexpected. Hamish's exit, we were able to react very quickly and defend the portfolio from unexpected changes. So that's exactly what we're about. Now, if I can come back, you mentioned the impact of interest rate before, Richard. As we've been talking over the last 6 months or so, we've been talking a lot about the risk of interest rate rises and the impacts that might have on our portfolios and the actions we've been taking to protect against that. And Mike, just before you spoke about some of those changes we made to protect our fixed interest portfolios, in particular our bond portfolios, from interest rate rises. We've seen interest rate rises come into play though, haven't we? And perhaps we can look at that from those two perspectives, from the fixed interest portfolio, if there's any more to add to that, and also from the growth side, the equity side, and the interest rate impacts. Mike, do you want to kick that off?
I think the challenge for all investors when a cycle changes is what effect that has on different sectors of the market. And equities have had a very robust bounce post-COVID in 2020. Interestingly, from a statistical point of view, if clients are interested, in March of 2020, when COVID really appeared in the lives we all have been used to, in the 6 weeks from when that occurred in March, the US government or the US Federal Reserve purchased more 10-year government bonds than in the whole 10 years that Ben Bernanke and Janet Yellen were in office. And that equated to approximately, this is in Australian dollars, $36 billion a day, every single day for 6 weeks. That's an amazing statistic, which Richard and I were privy to yesterday at a portfolio construction conference. But that quantum of money that has provided stimulus for economies to get beyond COVID, the challenge is that when that gets unwound and slowly changes, is the valuation for other assets, equities, property, infrastructure, changes. And so it's what's called a change in cap rates. And what we've seen is that particularly in the US, the NASDAQ is now down 20% from their January 4th highs, is that what we would call highly valued or high PE stock prices have come under lots of pressure. And there's been a rotation from what we would call growth to value shares. And that's something that we as an investment committee have made sure that we've had good exposure to what we would call value managers. So groups like L1, Allen Gray, Orbis, which basically have avoided the high PE stocks. That's not to say that our portfolios haven't got exposure to technology. So fund managers like Hyperion and T. Rowe Price have been absolutely affected in this 8 weeks since the market took a downturn. But I think from an investment committee point of view, and our investment committee meeting last week, we reviewed our positions and were very comfortable that we were well positioned on the defensive side of equities, that our portfolios, even with the volatility in markets, are well positioned to stand up in this uncertain period that we're going through.
Great, mate. So what we've seen is interest rates rise, and those highly valued, perhaps some might now say overvalued companies have had a pullback. And what drives markets to pull back those prices on those stuff? What is it about the interest rate change that does that, Mike or Richard?
Okay, well, as Mike alluded to beforehand, when you look at the valuation of investments, it's largely looking at future cash flows, dividends, rental, coupons for fixed interest. And you're saying, what's the value of those future cash flows today? That's why we buy something, buy a house. People should buy it for rental yield. When the interest rates have been quite low, the value of the future income coming in, it's not discounted as much. The mathematics of it is that when we get that rate rise there, the higher the PE, the more expensive, and the further out you have to go to get that income to bring it, to repay it to the asset. It becomes very sensitive to an interest rate rise. And so those inputs put into people and what assets they're going to purchase, if they foresee a rise in interest rate, they redo the calculation, and all of a sudden an organisation they thought a company, a stock was fairly priced, becomes overvalued. And sentiment flows, and we've seen that happen. It always happens in a hurry, Lee. I mean, these things, once the market gets onto it, they foresee it. And people call this saying, look, the central banks, maybe they were behind the curve in not raising interest rates earlier. And the market starts to get a bit impatient and thinking, right, when those interest rates rise coming, and more the weight of thought with the market is that the central banks will be forced into raising those interest rates. And there's been some other things which have been out there as well, been in the market, things like the supply and what's happened, supply of goods, the supply chains out there. What have we been doing? We've been locked down, been buying stuff, haven't we? Been buying a lot of things like that, less services, And so that puts pressures on prices as well. And so the market's believing if wage inflation might come, price inflation's coming on goods, it's coming. And all of a sudden that's happened. And so this January turnaround's happened pretty quickly, and it's affected the equities, it's affected real estate investment trusts, which are sensitive to yields as well, and the bond market, which we talked about right at the start. So it's been across the board.
And so in response to that, if I can summarise, and the FMD Investment Committee this rotation, if you like, position the bonds and fixed interest portfolios to protect from that, and I think we've done that effectively. And whilst you can't avoid an equity decline unless you exit the market, and we clearly wouldn't do that at this point, we have made sure we've got exposure to those value managers that are capturing this rotation again from growth to value. So if I move on from there, perhaps for a moment, we've talked about the big risk that we've been monitoring for a period of time, interest rate rises, which have come into play. There's obviously some big geopolitical risks on the horizon. How do you see that playing out? Mike, do you want to have a first go at that?
So firstly, markets hate uncertainty. So if you think back of the last couple of years, we've had COVID, which is an ongoing uncertainty to some degree. We're only really just, as of next week, we can come into the office and not wear masks, which is a big change. But so we've had COVID uncertainty. We've now got interest rate rises and inflation uncertainty, and now we've got a conflict in the middle of Europe. Russia supplies 50% of the gas needs to Europe. They supply 50% of the world's aluminium. So all of these, and they're a strong producer of oil and gas as well, oil and petrol. So not only have we got pressures from inflation without the conflict is just another layer of price pressures on certain parts of the economy. So energy and gas and materials, all of which Russia controls big parts of that market, they add to the effect of inflation and inflation pressures on price. So on one hand, markets, are fearful of that. And we've seen, our market here in Australia is off a couple of 100 points today. The Dow futures for tonight at the date is recording off another 800 points. So that whole, momentum of fear is very much at play in the marketplace. One thing I perhaps will say is that maybe the uncertainty and the geopolitical nature of the European crisis we've got at the moment may actually take a bit of heat out of central banks' decisions about raising rates too quickly, because the uncertainty's probably done some of the work for us. But from an investment point of view is, ultimately history says, this is not the first time Russia's invaded a country in Europe. They've already annexed Crimea. They've already taken part of Georgia back from Ukraine. So the political posturing between Russia and the West and the effect of NATO, and Putin doesn't want, Ukraine to become part of NATO. I would be hopeful that common sense prevails and that there is some sort of resolution that doesn't to cause too much political and physical damage to the economies and peoples of all the countries. Because in a war, Russia will also be a victim to some degree of the resulting conflict. So if we get a situation where we get some sort of resolution, I think markets will absorb the circumstances. It's the individual conflict on the border is not a game stopper to the world economy. If it gets out of hand, maybe the situation gets worse. But ultimately, I suspect that this will be resolved in some way over some period of time, and we'll look back and say, well, this was potentially an opportunity for markets to recover.
Thanks, Mike. Richard, would you add anything to that?
I think that's a good summation from the geopolitical point of view and what it does in adding that extra risk there. So that risk, when the investment committee looks at the outlook, nothing's black and white, and geopolitical risk has been in there, whether it be China and the US and the Central Europe, risk that we're seeing at the moment. So the outlook, though, from here, like Mike talked about, to say, where are we going from here? The pressure for central banks to look at raising interest rates may come back a bit. But also, Jim and Mike and I, when we were at the Portfolio Construction Conference, we were listening to the rhetoric about what's happening opening. And Mike talked about coming back into the office, services coming back, if you like, and maybe people's focusing on travel. Australia has opened up. We're able to go and travel internationally now with more safety and certainty. So where are people's money going to be spent? And so that supply chain issue we talked about before may ease back. And if that happens, there's less pressure on prices, and therefore maybe less pressure on the central banks to act in the way that everyone's anticipating they may act, Lee.
So there's some potential with all of those things that the inflationary pressures might reduce a little, although energy prices are clearly going to be driving some of that for a period of time yet.
Yeah. I think, Lee, I mean, perhaps maybe just to expand on this, I mean, and this is only one possible scenario, is that, the last 2 years people have been stuck home ordering TVs and lounge suites and all those sorts of things. And then from a factory point of view, people couldn't go to work to build those sorts of things because of COVID. And so, what typically happens in a supply-demand scenario is when demand's very strong, ultimately there's a supply response. And so they build more things. And you might just see that as the supply returns, by people being back in factories, the demand for those things rolls over because people go, well, I bought all those things and I want to go back to services and travel and eating out and holidays. And so you might see that the supply-demand equilibrium falls away quickly and inflationary pressures drop off. So I think that's a very valid potential outcome. Not that we're anchoring our portfolio decisions around a theory, but I think it has some legs, and I suspect that central banks and the inflation story is probably not going to be quite as bad as the way that markets are behaving.
Well, I do want to come back to that, Mike, but before we move off the geopolitical, obviously we've continued to talk about China and the Australian government. There's been a lot of talk in Parliament and outside of Parliament recently about China, but obviously the big risk really remains the potential for the China-Taiwan conflict. Do you see any changes, Richard? Do you see any changes or anything to be more concerned about in that space that we need to focus on?
Well, I think from the point of view that we've got a big distraction happening in Europe at the moment. So the geopolitical commentators might be saying, look, China might be comfortable with what's happening at the moment with attention being put into Europe. As far as I'm not a geopolitical expert, so I'm not going to comment on that outcome. But if that was to move forward, that would be certainly another risk in the market, would add to negative sentiment, Lee.
All right, well, we won't dwell on that too much. It seems like it might be a bit further along the horizon. But if we can look to the horizon before we wrap up, I wanted to start with, we've talked a lot about interest rates, but I wanted to say, let's look ahead on interest rates. Are they going to run much higher? What's our view? Do you think, are we looking at 7s, 8s, 10s, 1s, 2s? What are we looking at?
Look, long-term 10-year government bonds in Australia, what are they right now? About 2.1%. 2.1%. America a bit less than 2%. America, the inflation story seems to be they're further ahead, Lee, than where we're at. But remember, yes, where their cash rates are at the moment, are so way lower than that there's a long catch up even to get to 2%. And so that's what we were, Mike and I was saying, is whether the market is right in thinking they'll get to 2%. That's a 10-year view on interest rates. We're not talking sevens and so forth like that.
Yeah.
And the amount of indebtedness around the world, the central banks are going to be saying, yes, they're focusing on employment numbers, but they're certainly focused on indebtedness and the sensitivity of interest rates and what that does, and hence their reticence to move quickly. So to answer your question, low numbers in historical terms, but there's a lot of sensitivity to even those movements and what impact they'll have.
Thanks, Richard. Mike, can I ask you about the Aussie dollar? People are starting to think about travel, and that's a hip pocket concern, but it obviously has a lot of other impacts as well. What notoriously difficult to predict, but what are your thoughts?
Well, investment committee wise, we don't have any strong view on the Aussie dollar. We adjusted our hedging last year down. We were about 70% hedged to neutral, so we're now effectively 50% hedged, 50% unhedged. So no view either way. That's been slightly beneficial to our portfolios. As the dollar's fallen, if we'd been hedged, we would have lost money on being more hedged than unhedged. So we're neutral and don't have a strong view. I think on interest rates, just going back to the last question, I think Australia and the US are slightly different in terms of interest rate effects that we're likely to see here. The US interest rate markets had basically priced in 25 basis point interest rate rise to 1.75. That's now, with the conflict that we've seen, come back to 6 interest rate rises. I think the Federal Reserve will definitely start to raise interest rates next month. And I think what you're likely to see is short-term interest rates rise, but longer-term interest rates probably not rise much more. In Australia, the Reserve Bank here has communicated that they don't intend to raise interest rates. But I think what will happen in the domestic market for mortgages here, you'll see interest rates rise before our Reserve Bank moves rates. The predominant reason for that is that our Australian banks source roughly 50% of their funding from offshore. And as interest rates rise offshore, their funding costs will increase and they'll raise interest rates before I think the Reserve Bank raises official interest rates. So that's going to have some effect. But I think the markets tend to price those things into the system before they do occur. So slight diversion from your dollar question, but we don't have a view.
Thanks, Mike. So I think if we look at other asset classes, we've talked a bit about the volatility in equity markets, and that's likely to continue perhaps with all of this geopolitical disruption for a bit longer. We'll wait and see on how the cycle turns on the supply chain and whether that reduces input cost or not. Are there any other particular asset classes that are worth touching on before we wrap up, or any other final views that you'd like to share with the market?
What I'm sharing is that the investment committee, we met last week, and we started this thematic last year. Within the AMS funds, there are different areas where we're looking to add value and meeting the objectives of our clients' needs. Sure, we're looking at equities and bonds, but there's also property, and there's also private equity, and there's some illiquid investment premium that we have managed to capture over the last number of years. And people might look in their AMS funds, they've got investments with a group called Spire, which invests with a group in the US called Bridge, who invest into multifamily assets, also to commercial property. And that investment's been very successful for the funds, but it's been paying back through distributions. It has a time back, as they call what they say is buy the properties, improve them, sell them, move on. So we've now got, and also we've got some direct infrastructure investment in the portfolio as well. We're now looking at both those areas and opportunities to replace some of the outflow in those areas, Lee, and look at in this current environment, because that also gives some dampening of the volatility through this periods like this, as well as capturing return of a different sort in the portfolio.
Yeah, thanks, Richard. And I had the opportunity when we were allowed to travel to visit some of those multi-family developments in the US, and it's a unique asset class, one that's not at all in Australia really, and they're doing very well.
Yes, they are.
Yeah. Okay. Any final comments before we wrap up today?
Rides bumpy. We've been through bumpy rides before. We get through them. They're not comfortable at the time. But we have come off a strong uptick since COVID. We got through that very large bump. So we've got our clients' long-term goals in mind as we traverse through this, and we'll get through it.
Thanks, Richard. Anything from you, Mike?
No, look, I'd reiterate that. I think we've had a bumpy few years. The fastest fall in the market and the fastest recovery in the market when COVID hit in February, March of 20. This pullback in January, February was not unexpected from an IC perspective. So we expected markets to get some volatility. The actual reasons for it have probably been a little bit different. But ultimately, these are always investment opportunities when markets do have dislocated periods. It's not clear exactly when the opportunity set is a bit more visible, but that's what we are constantly looking at. And when we are clear in our views around where there's an opportunity, we will use our active management service to implement those changes, and as we always do, communicate that to our investors.
Thanks, Mike. Well, can I thank you, Richard, and thank you, Mike, for your contributions today. I hope our audience finds it valuable. I look forward to speaking to you again after the end of this quarter and updating everyone on progress with the investment committee and their clients' portfolios. Thanks very much.
Thanks, Luke.
Thanks, Luke.